All right, good afternoon or morning, depending on when you're joining or what part of the country you're joining from. We're going to let our attendees join, and we'll get started in here in a minute as people keep logging in. All right, it looks like our attendee list is pulling up here, so we'll go ahead and kick off our call here, rather. Um, Before I do that, I thought I would interject a little bit of humor here because the Kansas City Chiefs, if you aren't aware, won the Super Bowl, and there is a conspiracy going out about Taylor Swift and her favorite number 13. And I won't read you all of the ways that the number 13 played out in the Super Bowl. But just to add to all of the chaos and confusion around what Taylor Swift means in society is this happens to be February 13. And we scheduled this before we knew who's going to be in the Super Bowl. So add to the list of reasons to love or not love the Kansas City Chiefs and Taylor Swift. But welcome to the Three Corners Capital 2024 Virtual Investment Forum. I'm Chris Flores, and along with Steve Fortin, we're partners in Three Corners Capital, a Cincinnati-based wealth management firm. We're tasked with the day-to-day responsibility to steward client resources, and investments play a big part of that. This year, our investment forum is virtual because of a growing client base outside of Cincinnati, making this format easier to coordinate best-in-class speakers for a national clientele. The purpose of this webinar is to bring expert insights directly to our clients from the firms that play a role in our asset allocation and security selection process. We believe it's important to share ideas that you may not see written about in the news or shared on a TV screen. And we also want to help sift through the noise of all of the information that's available to us and be a trusted source for unbiased and objective advice. One quick housekeeping item is that due to industry regulations, we are not able to take live questions. In advance of this call, we've solicited questions from clients, and we'll use those in our Q&A session at the end. That said, if your question goes unanswered or if you have a question after the call based on what you hear, please reach out. Without further ado, let me introduce our first speaker. Andrew Updike is a CFA and senior economist with First Trust, a large asset manager headquartered in the suburb of Chicago, interestingly, Wheaton, Illinois, where I grew up. At First Trust, one of his roles is researching and studying the Fed and its actions, which is one of the biggest market questions right now, and certainly today's news, I'm sure he'll share on, plays into that. So without further ado, take it away, Andrew.
Yeah, absolutely. Well, thank you, everyone, for taking some time to join us today. This is a great day, in my opinion, to be having this conversation here on what is taking place on the economic front. Chris, can I share a couple slides? I think if you end yours, I can throw a couple slides up. Fantastic. What I want to do is lay the groundwork, some foundation from the economic side of the discussion. And this morning, we got the latest release on inflation, as everyone is trying to make this determination of can the Fed stick the landing this year. We believe, the market believes, I think most people agree that the path forward for the Fed is probably rate cuts rather than the rate hikes we've seen over the last 2 years. But how quickly can they do that? How aggressively can they do that? Is a major question. What we've seen in the economic data is that CPI, consumer prices, this takes a look at the broad basket of the things that a quote unquote normal household buys month in and month out. It's got the house, It's got the car, it's got the gas, it's got medical, it's got, well, you name it, right? It has been trending after that time period where it rose during COVID, right? It's turned over and it's trending in the right direction, but it remains notably above where the Fed wants to see it, which is at about 2% inflation. Now, the goods inflation, the supply chain discussions that we heard so much about in 2020 into 2021 have largely subsided, right? You turn on the TV today, you're not hearing so much about the Port of Long Beach with 111 ships waiting offshore, waiting to dock and unload. What we're dealing with today, and the data kind of really amplified this, is that the activity, the inflation pressures have shifted to the supply side of the economy. Now, I'm going to go in a minute to talk a little bit about why that is, and what the Fed needs to see this year to feel confident that inflation is trending lower. But real quick, let me just note, because this is a question I've been getting a bit of lately. If you've been watching the TV, reading the news, people said, well, are we going to see any surprises? Could we see something particularly here on the good side of inflation, given what's happened with geopolitical conflict? If you look at the Red Sea, you've heard about the Suez Canal. Right now, given the conflict in Israel and Gaza, they've been rerouting ships away from the Red Sea, away from the Suez Canal, and they've been rerouting them below Africa. It adds about 10 days, 4,000 miles to that trip. And what we've been seeing of late is that is increasing shipping costs. Now, that increase in shipping costs, and near doubling over the last month and a half, if this sustains, we ship so much of what we consume, this is likely to provide some temporary volatility in the inflation numbers. These geopolitical conflicts, just like back in 2022, right, when I don't think a ton of people were expecting Russia was going to go invade Ukraine, energy prices would skyrocket. Certainly the Fed did not anticipate that was going to be the case. This is one of those things they have to respond to as it comes up. The more visible piece of the equation, the piece that they're really trying to figure out right now, in order to understand one of the key sticking points in inflation, I want you to come back with me in time, okay, to those 2 months in 2020, March and April, where we weren't sure if we were allowed to go to the grocery store, right? We weren't sure if the Starbucks was even going to be open. If you remember, during this time, just how crazy it got. This is when we had the great toilet paper run of 2020, right? It was mass chaos, mass confusion. You couldn't go back to the economic history books and say, how do we respond through a shutdown and a shelter in place? How do we progress after that environment we were in? We really didn't have historical precedents. But again, what we talked about a few minutes ago, what we saw in 2020 into 2021 was a transitioning of the economy. When we moved from the outside inside and the inside online, right? You remember the Peloton craze? We were sitting at home thinking, well, we don't know if this is going to last a month or 2 months or 3 months. I can't go to the gym, so of course I'm going to buy an exercise bike. I'm going to buy 2 bikes. I'm going to put them in my basement, and me and my spouse, we're going to get up every morning and cycle, and we're going to be the fittest couple on the block when COVID's over. Well, that craze lasted for about 3 weeks, because that's roughly how long it takes you to realize you don't like to cycle, right? But we saw this transitioning in what we were doing, how we were purchasing, what we were buying. The good side came back robustly in 2020 into 2021. But the issue we're dealing with today has to do with a bit of a reversal of that process. Okay, when we moved the employees, when we moved the inventories, and we moved the investment dollars, it did fix the most visible issue directly in front of us. But as we got into 2021, most notably April of 2021, since that time period, what's driving the economy has shifted back towards the more historical mix. I travel just about every single week. I'm on the road 45 weeks of the year. I go East Coast, West Coast, North, South, across the Midwest. I'm about to be going to Bismarck, North Dakota. When we've had conversations with businesses, when I've had conversations going through the airports, which have been increasingly busy, what I'm hearing from this side of the equation is, look, we are having a tough time. We have our activity back. The consumer demand is there. Consumers want to be here. They're excited to be back out and traveling, eating out at sporting events, at concerts. But we've had a really hard time getting the workers back. We lost them in here, and this side hasn't want to let them go. Now, part of this is the conflict we've got going on in Washington. And I'm not talking about the conflict between the Democrats and the Republicans. There's a conflict of sorts going on between the Federal Reserve, whose mandate is to get inflation down to 2%, and Congress, whose job is to get reelected. We've had things, for example, like the CHIPS Act, the Inflation Reduction Act last year, which has led to a big pickup in manufacturing construction. Again, their activity as a whole, their new orders, their production has been relatively flat, but they have been incentivized to build. And these businesses have said, well, look, as we sit here, we have plants coming online in 12 to 18 months. We do not want to let our workers go and hope we can rehire them in 9, 12, 18 months. We watched last year the labor disputes. We watched the UPS drivers. We watched what happened with the airline associations. We watched the United Auto Workers, right? They watched the United Auto Workers conflict, and they said, hey, look, they weren't asking for much. The United Auto Workers said, we just want a 40% pay increase. We want the hours worked drop from 38 to 32, and we want the return of full pension benefits. These goods-based companies said, look, right, labor is scarce today. The unemployment rate remains near some of the lowest levels we have seen in 60 years. And with the baby boomer generation right now retiring in greater numbers, right, this has become a bit of a headwind to finding qualified workers. In fact, this morning, the small and mid-sized businesses, they had one of their surveys this morning. They said, access to quality labor is our #1 problem. And so with this allocation, workers where there's not necessarily the work to do, a lack of workers where the demand is, but they can't quite honestly afford to raise the wages. Their rents are higher, their input costs are higher. They said, look, this is a bit of a tough environment for us. And so the Fed is hoping that we get those services to continue to trend lower. They're hoping that this number continues moving in this positive direction, but they have found over the last 4 months that core inflation number has only moved by 0.1%, from 4.0% to 3.9%. I think this morning what the market was saying is this may take us a little bit longer. Now, the last thing I want to note on the economic front, I'm going to show you these two charts. People said, well, doesn't the Fed kind of need to move? Consumers, businesses, the national debt has grown. Don't consumers need an easing from the Fed? If we don't, are we at risk of seeing that dreaded R word, the recession? And when I see questions like that, here's how I really like to dive into the data. I want to lay out where we see consumers today, because I think it gives us an idea of their capacity to spend throughout 2024. Yes, debt is at an all-time record high. And I've heard people say it looks a bit like this one. What's to say if the Fed doesn't move that we don't see a repeat of 07, 08, 09? They said, well, first off, you need to understand, where is the debt? The biggest source of debt for consumers, the largest single monthly obligation, tends to be mortgages. And let's not forget what happened. The growth in mortgage debt outstanding was primarily driven in that 2020 into 2021 phase, when mortgage rates fell down below 3%. And not only did they benefit, right, we saw massive refinancing activity. Consumers, quite frankly, took their single largest payment they were making month in and month out and improved their capacity to pay. Now, people look and say, but prices are up and mortgage debt outstanding is up. Why are these two periods? How are they really that different? Couldn't we see a housing collapse? Well, back here, it's important to know 45% of mortgages were adjustable rate mortgages. Here, that number is less than 5%, right? We've locked in lower rates for a longer period of time. That doesn't mean you won't see some cracks. Autos and credit cards have been coming into focus. People have said, hey, you remember in 2020 when the used cars cost more than the new cars, we started paying up. And the credit cards, we started adding on some of the debt as we took the trips, as we made some of these decisions to go out and spend. These are categories that are coming up to the forefront, and they're a bit of a headwind to consumer spending as I look through the remainder of this year. The biggest item that really I think is coming into that adjustment period is student loans. Remember that student loans, they really didn't need to be paid for about 3 years. As they started recurring interest in September, payments started coming due in October, there's a correlation among these three groups, the autos, the credit cards, the student loans. What I would expect to see this year is a consumer who, quite frankly, is relatively healthy, has the capacity to pay their bills, still has cash in the bank, but expect them to moderate. Companies, I would expect them to moderate this year as we get used to rates a little bit higher for a little bit longer. A Fed that's tasked with doing the job wants to do that job, but it's getting harder to get to 2%. It's a fight I think we will see throughout this year. So from the economic front, a moderation from 2023, a continuation from the Fed of rates remaining above where they've historically been. But I do believe they will start that cut process. The question of how long, how fast, really depends on how quickly the labor market heals. With that, Chris, why don't I pass it to you and we can dive into the equity side.
Yeah, thanks. Well, we'll keep our questions to the end, but obviously great insight. Thanks. Let me introduce Ann Balch. Ann is Vice President in the U.S. Equity Group at JP Morgan Asset Management. In her role, she serves as an investment expert in U.S. markets with an emphasis on value stocks. JP Morgan is a part of, or asset management is a part of JP Morgan Chase, making it one of the largest multinational financial services firms in the world. So she's got plenty of resources to share with us.
Excellent. Well, thank you so much for having me. And I am thrilled to join you from a very snowy New York City. And of course, here to talk about equity markets. And I think certainly coming off of last year, that was very interesting to be an investor in equity markets. We seem to have skirted a recession that many thought was imminent. And we actually ended the year with the S&P up 26%. So I think the question now for clients is, where do we go from here? And what I wanted to maybe just start off with is that when you hear about equity markets reaching all-time highs, if you're listening to CNBC or maybe reading different articles, again, that all-time high equity market can be a little bit intimidating to invest in, and maybe you're looking for a better opportunity for entry. But I think an interesting stat is that over the last 50 years or so, if you invested in the S&P at all-time highs, over 70% of the time, your investment would have been higher a year later with an average return of 9.4%. So again, if you invested the S&P at an all-time high, over 70% of the time, your investment would have been higher a year later to the tune of 9.4%. And importantly, in investing at any other time, so high, low, anything in between, your average return was actually 9%. So not a very big difference. And I think that speaks to that saying of it's not timing the market of when to get in or out, it's time in the market. And so if we just look under the hood at where we are today in equity markets, this is first slide that we're looking at the composition of the S&P 500. So the 500 largest companies in the US, I think what's glaring right now is the historic concentration risk. And what I mean by that is that if you focus on the top right hand side, and I apologize, I'm not as good as Andrew in terms of annotating, but if you look at the top right-hand side, this is looking at the weight of the top 10 stocks in the S&P. So names like Apple, Microsoft, they are currently making up a third of the S&P. So said another way, for every dollar you put into the S&P, 33 cents of that goes to just 10 names. And looking back to the 90s on this graph, you could see that that is very rare, that concentration. And ultimately, of course, stocks trading at higher prices, that means that we expect them to deliver higher earnings growth for shareholders. But if you look below at the bottom right chart, we see that the earnings contribution of these names have actually contributed less than a fourth to the overall earnings picture. So while these certainly are world-class companies, we want exposure to them, we also want to be very thoughtful about the risk associated with them and just the concentration or maybe the weighting that we're giving them to our within our portfolios. I think though, elephant in the room, you can point to the left-hand side where this is showing you performance of those top 10 stocks and the rest of the market going back to the beginning of 2023. And you could say that, hey, these opportunities are, these names should be the biggest and the best because over the last year, they've made up about 70% of performance, or they've been up 70%, with the rest of the stocks in blue that are up just 10%. And so I think point being is that, yes, you were probably thrilled to own growth in your portfolio or these top 10 names that tend to be growthier last year. But for us, we want to look at, where do we want to invest moving forward? And we see that the opportunities right now for stocks that are the most interesting to us are where that intersection of attractive valuations, or rather, what is that attractive price to pay for a stock, and where we see meaningful expected earnings growth. And so from a valuation standpoint, maybe just starting there, we tend to focus on the forward PE ratio, which stands for price to earnings. So what that means is what's the price of a company compared to the earnings you would expect over the next year. That first data point here within the text box. And I think maybe an easier way to think about this, if you're like me, you go to a supermarket and you ultimately want to get the most bang for your buck, right? So if you look at a price tag on an item, you see the overall price of that item, but then also you would see the unit price amount. So it typically tells you what's the price per ounce or what's the price per count. Here, very similar. We want to look at not only just what's the price of that stock, but what's the PE ratio under the hood. And really the top 10 names, you can see they're trading at 30 times forward earnings, which is almost double the rest of the market. You see those remaining stocks here in light blue. And so, if you talk to our growth team, though, they will tell you that there are many secular growth drivers behind AI, weight loss drugs, infrastructure spending, et cetera. And they are supporting these valuations for many of these companies. And ultimately, they find them attractive considering the growth that they see in the companies over the next 5-10 years. So absolutely, we want to invest in growth names, but we just, again, want to be very selective of where we are investing in growth and just the weighting that we're giving it to in our portfolio. Opposite to growth, we have value stocks. So think of your blue chip companies like Procter & Gamble or McDonald's. These are trading at valuations, it's not on the slide, but they're trading at valuations closer to 14 times forward earnings. So that's a 60% discount to these top 10 names. And I think ultimately in our portfolio, that offers a bit of zig and zag. So growth being the zig to the value zag. And I think the reason of why you'd want to own both growth and value is I think the most recent example is 2022. Value significantly outperformed growth. Opposite happened in 2023 with growth outperforming, and no one can predict these style swings. So again, we want to own both of the best names under the hood for each style to have different exposures in your portfolio for the zigs and the zags, which ultimately helps smoothen out the ride for your performance. I think also from a valuation standpoint, in terms of thinking about those value names that are a bit cheaper, that also gives us a lot of room to run if the markets do well. But on the flip side, if markets don't do well, or we see a sell-off, it's really hard to hurt yourself falling out of a basement window. Again, considering your starting point is so low, which the opposite could be said for growth. You can hurt yourself falling out of the attic. We know we want exposure to these premium companies and they have great growth potentials over the long term. But in the short term, if we could see more swings or volatility, again, we just want to make sure that we're protecting on that downside. I think an example is that if you look at Google, just the expectations right now are so high, and they came out with their earnings report more recently, which was good, not great. But again, because those expectations are so high, that spooked some in the market. And we saw Google lost $180 billion in market cap right afterwards. Again, this is a great long-term name, but in the short term, we can see a bit more volatility, and we want to pair our growth and our value managers to smoothen out that ride. So that's kind of from a valuation standpoint, being selective. From an earnings standpoint, our view, and I think this is really important, our view is that in this year, we are going to get more breadth in the market, meaning that if you think about last year, tech was the only name in town. Tech names actually were up about 60% last year, or you could see on the slide, actually almost over 70 if you through to today, so about a year and 2 months, where the rest of the names, so the remaining stocks in blue were up just 10%. I think that is very staggering. We don't expect that to be the same case moving forward. So for next year, if we ask our research team, for this year, for 2024, our research team is expecting 12% earnings growth. Importantly, 50% or half of that earnings growth is supposed to come from the top 10 names, so we certainly want to hold them. However, the rest of the earnings growth is coming from the other 490 names. And so I talked a little bit about that valuation standpoint of the starting point that gives us lovely room to run. But I think just we see a lot of opportunities just outside of technology, like financials, industrials, and consumer staples. So again, want to be mindful of valuations and be selective, but moving forward, we do think that we're going to have more breadth in the market and strong earnings potential moving forward. Now, I think maybe just elephant in the room is looking at CD, right? So if you look at this slide, this is looking at peak 6-month CD rates in gray during previous rate hiking cycles. You can see those rate hiking cycles at the bottom. And then what was that 12 or subsequent 12-month total return, again, following the peak 6-month CD rate? Because I think if you take a step back, we can't deny that money market funds more recently in CDs around 5%. That's pretty attractive and really more of that warm blanket for clients, especially for their short-term needs if you're looking to buy a house more in the shorter term or so on and so forth. But I think in terms of longer term opportunities, this slide does a nice job of just highlighting some of the other ideas because A, these products have a ceiling. I just mentioned the S&P was up last year 26%. These have a ceiling around 5%. So that's money left on the sidelines. But then B, while CDs look attractive today, as we just heard from Andrew, we don't think the Fed is going to continue rate hiking at the levels that they have been. We think that they're around peak at this point. And so there may be better opportunities moving forward for deploying excess capital outside of CDs. And then maybe just to end here, I talked a little bit about time in the market and also looping in my point about diversifying, particularly across your equities. I think this last slide ties it all together really nicely. It shows a range of the total returns over the short term and long term period. So what we're looking at is historical returns going back to the 1950s, stocks in green, bonds in blue, and that 60/40 portfolio in gray. And that's across various holding time periods on the bottom, you can see. But really, this page is advocating for more of a simple, balanced portfolio and appropriate time horizon. Because if you think about it in the 1-year period, you can have more short-term volatility where the highest return we've seen for stocks in the 1 year has been 47% to the upside. Unfortunately, on the other end, it's been about 40% to the downside. However, if you take this time period out longer for a 10-year time horizon for stocks, your max has been 19% on the upside and just -1 on the downside. Take it over even longer, 20-year rolling period, your downside for stocks is actually positive. So just 6% to the upside, where your max has been 17% to the upside. And so I think really, yes, there could be some bumps along the way when investing in equities, that is for sure. But over the long term, we've only seen the S&P go up. And so we want to be properly positioned just to benefit from that return and of course, reach our long-term goals. So again, being mindful of valuations where we are today, being really selective of where we're willing to pay up for those valuations, but also not ignoring those opportunities that might have just been a bit cheaper at the moment, but we think moving forward have really attractive earnings potential. But again, always trying to be diversified across value and growth. And with that, I want to pause here and give time for the other speakers.
Great. Thanks, Anne. And we are users of the saying time in the market, not timing the market. So thanks for
Excellent.
the unprovoked pitch. Next up is Emily Sweet. Emily is a CFA and Vice President and Portfolio Advisor for Wellington Management. In her role, she works directly with portfolio managers and macro analysts across broad asset classes from stocks to bonds, making her a great asset to communicate ideas to clients. And for those that may not be familiar, Wellington Management is a large private investment firm in Boston. Take it away, Emily.
Thanks so much, Chris. I am going to say that I'm the worst person at sharing slides, but hopefully, can you see that okay?
Yes, that's great.
Yes.
Thanks.
Okay. Thanks so much for having me. And I just want to make a quick note about my role. My title is portfolio advisor, but my role is really working with our sub-advised relationships like Hartford funds to help them work with financial advisors to see where we can find solutions. So not advocating for any particular investment here. What I'd love to share with you today is some views from the fixed income side of things, now that you've heard macro and you've heard some equity, and really want to tackle the issue of cash, where there's a huge investment pool in really attractive cash, as I think Anne just mentioned. And so to do that, I want to talk first about the Fed and inflation, and then we can certainly see why cash is so attractive. But there, as Anne highlighted, there's some real opportunity costs there if we get a change in interest rates. And finally, I'd love to give you a framework for thinking about options if you are trying to bridge the gap between cash and fixed income or other asset classes when the time is right. So first, I'll start here with how we got to the point where cash is so attractive. I think Andrew also showed a slide on inflation too. But here what you're looking at is across the globe, headline inflation changes since 2021. And you can see that there was a big mountain that got climbed that wasn't initially in the Fed's language about inflation being transitory, if we can think back to those days. And if we focus here in the US on the top left of this screen here, you can see that inflation reached almost 9% at a peak in mid 2022. And since then, the Fed's policy response, as other central banks have done around the world, is to step in with quick and sharp policy response to try and fight inflation. And there's been many challenges to that. I think one of the things that comes to mind for me that Andrew mentioned is the lock-in of really low-cost fixed-rate mortgages. But the Fed has had a really difficult time, even with 550 basis points of sharp, quick tightening in fighting inflation. But if you'll look on that US chart down to late last year, you'll see that things came down quite a bit. And markets started pricing in this sort of euphoric nirvana situation where all of a sudden we've conquered inflation, we are going to get steady Fed cuts, and it was sort of this nirvana priced in. So what I want to highlight here is that perhaps that's a bit too optimistic. And if we look at what is actually priced into policy rates, and this is at the end of last year, but still relatively applicable a month later, what markets are expecting is this very orderly Fed cutting of interest rates with a soft landing. So in other words, the Fed can meet their target of inflation without really throwing too much of a wrench into growth and into the labor markets. And what I would suggest is that path seems possibly too optimistic. And there are different paths that we could take from here that is a real reason why there's so many in the market that are still concentrated in cash. And to throw out a few risks, a couple of risks that we see is growth either surprising to the upside or to the downside, which could really change this trajectory of the way interest rate policy happens. And so if we get growth going to the upside, the consumer keeps spending, we may get inflation kick back in. That could cause the Fed to step back in. On the other hand, we know that this sharp and quick policy response has lagged impacts. And if those impacts keep feeding through to softer data, which at this point we're not seeing too much of, we could get softer data coming in and we could get recessionary talk. I want to point out that recessionary talk is not really the base case based on the strength of the consumer, resilience of economies, and also that in the US especially, we're getting a lot of debt spending. So moving on to, you can imagine why cash is so attractive at 5+% in many cases. It's an asset class that we really haven't as investors had available to us in quite a long time now. And so what this has led to is, and can you see, this is blocked on my screen. Let me just make sure we can highlight the right-hand part of this chart. Can you see that, Chris, the right-hand tick up? Great. So we are at levels of cash that are close to $6 trillion. And that's no surprise. It is a really attractive risk-free asset class to park your money and earn a decent return that we haven't seen in many years. But I also want to highlight that based on the different directions things could go, if we don't get that orderly soft landing scenario, it may be worth considering having a path to transition assets out of cash, based on knowing that the Fed has this propensity to cut rates. So I want to take you through some situation analysis, but first, look at the across fixed income categories. Now we go from sort of least risky with US Treasuries on the left-hand side, all the way to the right-hand side with bank loans, where you're getting more yield and more risk. You can see based on the placement of the purple dots, which is the median of yield over the last 10 years, versus where we are now in terms of yield to worst across these fixed income categories today, that income and total return in fixed income asset classes is a lot more attractive also than it has been. So if we move here, this is the situation analysis and is by no means meant to represent what we think is going to happen. But if we put everything in a vacuum and we say, we're going to shock interest rates by 100 basis points, which at the rate the Fed has moved recently, that's 4 25 basis point moves. But for simplicity's sake, we're going to raise interest rates by 100 basis points, as denoted by blue, or lower them by 100 basis points, or increase them. Flip that around. I just said that backward. We're either going to increase or decrease interest rates by 100 basis points and see how these categories could react hypothetically over the next 12 months. So what you can see is for an interest rate cut, which is sort of what's looking like is going to happen at this point, you see that there is a lot of return that could be gained across fixed income categories that should outpace cash based on what we know through rate hiking cycles in history to be true. So I think Anne showed a version of this chart that was based on CD rates. This is a similar type of chart. If we look at after the last 5 Fed rate hiking cycles, after the Fed was done, and we roll it forward 12 months, this is how each of these asset classes on average has performed 12 months later. And you can see the point here is not the actual numbers, but the size and direction of the fixed income categories versus cash. Now, this is not meant to be a get out of cash now, but we find it helpful with our clients to look at these scenario analysis to say, okay, we're not exactly sure which way things are going to go, but we know that the Fed is more likely to cut rates at this point. And if that's the case, let's look at what has tended over history to happen across asset classes. So the last thing that I want to share with you is looking how different categories in the fixed income space can be used in portfolios. So our framework tends to be that we look at fixed income categories for 4 different things. So it could be capital preservation, as in use of cash, income generation, which is typically pretty important, total return, which of course is income plus price return in fixed income, and also diversification. And so I think it can be helpful in the exercise of mapping out where to go from cash next to look at how different categories fit. So here, a simple example of yield on the y-axis, which is generally a measure of compensation for risk. And then on the x-axis, correlation to the S&P 500 over a 15-year history. So giving you a sense of volatility, giving you a sense of diversification potential, or high correlation with equity markets. In our 12-month asset allocation view, we're sort of favoring the defensive fixed income categories like an investment grade corporate, munis, to help balance the risks in the fixed income markets given the wide range of potential outcomes. Generally, we're a little lighter on growth categories like bank loans, high yield, and emerging market debt, because those are sort of tight on spreads, which means you aren't necessarily getting compensated like you may want to for the risk that you're taking. So wanted to give you a couple of ideas here, but the real meat of the story is in markets, we're sort of pricing in a scenario that may not play out. It may not be as orderly as we think it may be. So it's worth thinking about where do we go next from cash? And there are plenty of options with higher income potential than we've seen in years in the fixed income category that can fit those needs.
Okay, thank you, Emily. That was super helpful. And we've got a few minutes for Q&A. So let me start off with a question about inflation, which is a hot topic, as you know. We certainly had another CPI release this morning for the month of January, which showed a good decrease in the headline number from 3.4% to 3.1%. But also it showed that core prices, which core means excluding food and energy, stayed at 3.9% instead of dropping somewhat. So overall, the overall reading for January was slightly higher than consensus estimates. And so we received a question, do we think that we might see another surge in inflation, and what could cause that? And so perhaps, Andrew, we could start with you.
Yeah, no, it's a great question. So there's a couple important things to remember. We got the CPI Consumer Price Index released this morning. The headline number, which just takes everything together, it has swung rather wildly over the last 2 years, mainly because of what happened with Russia, Ukraine, some significant swings in energy prices, which remains kind of front and center. We've got geopolitical conflict still taking place. The Fed prefers to look at that core number. Historically, they've said, let's take out food and energy, the most volatile components, and let's see what broad inflation underneath is doing. Is there risk that that number could see a jump? There are a few reasons that that could happen. One, again, geopolitical conflict, as we looked at the very beginning. Shipping rates, we ship roughly, I mean, other than some service, you go get a haircut, that might not be as impacted, some of the food service, but so much of what we do as a nation, it has to get transported from point A to point B. And some people say, well, isn't that the Red Sea? How much of that shipping really comes to the United States? Remember, we end up rerouting stuff to fill gaps where Europe is having difficulty getting things. So that is one risk. But I would argue the bigger risk this year, the thing that I'm most focused on is, as the Fed is making this determination, when to start cutting, how aggressively to start cutting, as they look out into this year, if they get too aggressive, their fear is a repeat of the 1970s, right? That's their nightmare. There's 2 times in history the Fed thinks they kind of really messed things up. One was in the 1930s, around the time of the Great Depression. The second one was in the 1970s, where inflation was trending in the right direction. They started to cut rather aggressively to support economic activity, and inflation took right back off. Small, mid-sized businesses have been a key reason inflation's been trending down in areas like services, as they've kind of paused on hiring. If you were to see the Fed get aggressive, I think some of those companies would step back in and say, rates are lower, I can invest again in people, in products, in projects. So, is there a risk? I think it's still there. I think that is, for Jerome Powell in particular, as he thinks about what's my legacy from here, that's one of the biggest concerns I think they're looking at and saying, maybe we take a more cautious approach. Let's make sure inflation is down and can sustain there.
Okay, great. Thank you, Andrew. So moving on, we had a couple questions about artificial intelligence, which has certainly been in the news a lot. And the questions are around, is it more of a fad? Has it been hyped up too much? Or do you see, real long-term opportunities for investors? And so perhaps, Anne, we start with you.
Yeah, I'm happy to kick this one off. And it's a great question. It's certainly one that we have been talking a lot about on the floor here on the equities team. And I think the short answer is it's not a fad. It is certainly here to stay. We think it's going to be very transformational in terms of affecting various sectors. So it's not just helping technology, right? But if you think about if we're using more data, if we're using more semiconductors and whatnot, and just focusing more on AI, we need to build data centers to power that. So how do you do that? You build these data centers, which industrial names are certainly benefiting from. Think about the CHIPS Act, right? There are many industrial names that needed to supply the materials for that, needed to actually build these data centers, so on and so forth. That also helps railroads, right? So you need freight to help bring that in. So that helps with their volume and their overall revenue. So I think that yes, we think that AI is certainly here to stay. I don't think it's only the technology sectors that will benefit from it. And the third component is that I think if you look at earnings calls over the last 6 months or so, the uptick in the amount of companies that are just saying the name AI and saying that we're using it or we're thinking about using it has dramatically increased. So I think you have to be a bit diligent in terms of really under the hood, how are they using it? Is it actually transforming their company? If can we look into the hood and see how are they being actually more efficient with AI? How is it really affecting their revenue? So again, I think we certainly want to be very active, very mindful of the companies that you're investing in, not just kind of blanket AI. But the other thing is that I think it also just, anecdotally, if you ask around your friends or family, even on a personal level, more and more people are using it, whether you're using AI to help you write a cover letter for a new job. I have some friends that had AI or used AI to help them write their maid of honor speech or help them build out a vacation for themselves. So I think, yes, on a personal level, you see more people using it. Obviously, on a professional level, you see more companies leveraging AI. But I think you definitely need to be diligent in terms of looking under the hood and actually seeing, is that going to transform that company or is it just going to give them an added little boost and not revolutionize their business? So definitely need to be more mindful of it.
Okay, great. And we'll make time for one more question. We had a couple questions around, of course, this is an election year, presidential election, as well as many other elections. And so how do these elections impact your thinking about the economic and market situation and security selection, if at all? And so perhaps, Emily, we'll throw this tough one your way.
I knew that one was going to come my way. I think it's a bit early to be able to raise investment implications. Two of the things that we have been doing a lot of talking about, and Andrew probably has a good opinion on this too, is the way that we're spending 8% of GDP on the fiscal side. And while I think that's a possible that keeps us out of a recession, that we're spending so much, I think it also is something both parties have a propensity to do, to keep spending, especially in an election year. And I think that's something that we really need to keep a close eye on, because in the short term, it may not create a huge problem. It's something that's probably not sustainable. And the rest of the world sees that too. So I think that that is something that impacts the risk premia on our debt and has longer term implications. The other thing that I think is something worth watching is the immigration picture. And I think because I think Andrew mentioned this, but the Fed is really focused on the labor market, and immigration has really helped them. Increasing immigration has helped them tackle the labor market tightness by adding supply. So I think that's another topic that we want to keep a close eye on as it relates to labor market tightness and the Fed's ability to sort of keep getting inflation under control.
Okay,
Henry,
fantastic.
do you want to add anything to the election year comments?
Yeah. Was that to me, just to make sure?
Yeah, just Emily said you
Yeah.
might have an opinion, so I just wanted to make a space for you to share if you do.
Yeah, fantastic. Yes. So a couple points on that. I think she's absolutely correct. That debt question, I mean, the fact that we spent last year 6, 7, 8% of GDP in a year, we ran that as the deficit in a year where we didn't have a global war, we didn't have a recession, the unemployment rate below 4%. It's unsustainable from an economic standpoint. And I look back at history. You look post World War II. You look at what happened, quite honestly, in the 1970s after the rise in inflation. That spending, CHIPS Act, Inflation Reduction Act, fiscal spending, the IMF estimates added about 2% to real GDP last year in a year that we grew 3%, essentially saying government kind of propped things up. But I do think over the next few years, we are going to see more and more focus on managing the debt. And yes, we can do that. People have said, look, Republicans, Democrats, they can't agree on much, but remember, we managed the debt. We really got it under control starting in about 1980 for 12, 16 years, from the Republican from California all the way through to the Democrat from Arkansas. I mean, Clinton left office running a surplus, paying off some of the debt that had built up before. Here's what I will say. When I think about investment implications, and I think about the impact of election years, there's so many wild cards in this, but there is one thing that has traditionally rung true again and again and again, and that is when the election results come in, roughly half the country is going to be happy, roughly half the country is going to be upset, and then the next day everybody goes back to work. And Apple builds another iPhone, and Amazon puts another distribution facility closer to your house. I think personally that politics gets more mind share than is probably warranted. And if you look throughout history at, should you be in or out of the markets depending on who's in the White House, Congress, the House, the Senate, historically, that time in the market has more than dominated for those short-term swings. So, as we go through this election year, it can be incredibly frustrating to watch. It can really heighten emotions, but one of the best things we can quite honestly do is take a step back, turn off the TV, right, and look at those broader trends that are taking place, because those are going to be far more impactful than what the candidates say.
Yes, well said, well said. And thank you to everybody for sticking with us. We're past our 12:45 stated time, but I want to say thank you very much to our panel, Andrew, Anne, and Emily. Your thoughts and insights have been very helpful, and we greatly appreciate your time with us today and wish you all the best in 2024. Thank you to all for attending our 2024 Investment Forum. We hope you found it very informative and helpful. If we didn't get to your question or you'd like to discuss your personal portfolio, as always, please reach out to us. And thanks again. Take care and have a great day.
Thank you.
Thank you.